Welcome, everyone, to the Deep Dive. We're here to cut through the noise and get straight to the core insights. Today, we're putting Waystar, the healthcare payments tech company, under the microscope. We've just gone through their Q2 2025 earnings call, and let me tell you, there is a lot to talk about. We'll cover the key numbers, dig into their big AI everywhere strategy, look at a really significant acquisition they just announced, and, wrap it up with our not financial advice trade ideas segment. Think of this as your fast track to understanding Waystar's latest performance and what it means.
Exactly. Waystar is right in the middle of that complex world of getting healthcare providers paid, revenue cycle management. And this quarter, well, it wasn't just about the strong financials. It really gave us a clear look at how they're using AI and making some pretty bold strategic plays. It definitely sets the stage for what might be next for them.
Okay, let's jump right into those Q2 results then. Top line, what did we see?
Well, they delivered some pretty compelling figures. Non-GAAP EPS came in at $0.36. That comfortably beat the consensus estimate, which was around $0.33.
Okay, so a solid beat on earnings. What about revenue?
Revenue was also strong. Came in at $270.7 million. That was well above the $255 to $258 million the street was looking for. Represents about 15% growth year over year.
15%. That's solid growth, shows good demand.
Definitely. And that strength wasn't just, at the top line. Their operational efficiency really came through too. Adjusted EBITDA hit $112.6 million.
Okay. And the margin on that?
That translates to a healthy 42% margin, which is actually, above their stated long-term target of around 40%.
Impressive. Shows good cost management.
Right. And the cash flow looked good too. $97 million from operations. And unlevered free cash flow was $111 million. That converted at an impressive 98% of their adjusted EBITDA.
98% conversion. So almost all their profit turned into actual cash. That's a great sign.
It really is. Very strong financial health indicator.
And beyond the core financials, what about their KPIs? The key performance indicators, those often tell a deeper story about customer health.
Absolutely. And they looked good. Net revenue retention, or NRR, was excellent. Came in at 115%.
115. So existing clients are spending 15% more with them year over year?
That's exactly it.
Yeah.
They're not just staying, they're buying more, using more services. It's a really strong sign of product value and stickiness. Plus, they grew their base of larger clients, those spending over $100,000 a year, by 14%. They now have 12,268 of those clients.
So retaining and expanding within the customer base, that's powerful.
Very powerful in a competitive space like this.
Okay, let's unpack this a bit more, because beyond these strong numbers, Waystar keeps talking about this AI everywhere strategy. Is this just talk, or are we seeing real, tangible impact for the providers using their platform?
Yeah, that's the key question, right? And the answer seems to be, yes, it's having a real impact. They're showing concrete results. Their AI software, for instance, prevented nearly $6 billion in denied claims just in the first half of this year.
$6 billion. Wow. That's a massive number.
It's huge. Think about how much administrative hassle and lost revenue that represents for hospitals and doctors. Preventing that scale of denials is a game changer for a provider's financial health. And even when claims do get denied, their AI tools help speed up the appeals process and actually increase the chances of getting that denial overturned.
So it's both prevention and better recovery. Where else is this AI making a difference?
Well, another big area is insurance coverage and eligibility. Finding the right insurance for a patient can be tricky. Their AI can automatically identify the correct insurance in up to 55% of those cases that might otherwise just get written off as bad debt. That recovers revenue in seconds. For a medium-sized health system, they estimate that could be over $20 million in extra reimbursement annually.
$20 million just from finding the right insurance faster.
Yeah. And think about what that $20 million means for a hospital operating on thin margins. It's significant. It could directly impact patient care funding.
Okay. And they also launched something called Waystar Altitude AI, their generative AI offering. What's that specifically doing?
Right. Altitude AI. That seems particularly focused on making processes even more efficient. They're saying it boosts the productivity of handling claim appeals by 70%. Yeah. 70%. And it leads to double-digit increases in the rate those appeals are successful.
70% productivity boost. That's incredible.
It really is. They framed it as freeing up capacity equivalent to almost 10 full-time employees for a typical mid-sized health system, just on appeals. And, it raises the question of their bigger vision here. The CEO talked about this ultimate goal,
Which is?
to use AI to create the perfect undeniable claim. Basically eliminate the friction, the denials, the appeals altogether by getting it right the first time, every time.
Yeah.
It's definitely ambitious, but it explains why they're pushing AI so hard across the board.
A perfect, undeniable claim. That's quite a goal. Okay, and speaking of ambitious moves, they also dropped news of a major acquisition just before the call. Iodine Software.
Yes, the Iodine software deal. This isn't just a small tuck-in. It's a pretty big strategic move. They're acquiring Iodine for $1.25 billion. It's a 50-50 cash and stock deal.
Okay, $1.25 billion. What does Iodine actually do, and why is Waystar buying them?
Iodine is a leader in AI-powered clinical intelligence. So think about insights derived directly from clinical documentation, physician notes, that kind of thing. The rationale here is it moves Waystar upstream.
Upstream? Meaning
They're getting involved earlier in the process, not just managing the claim after it's created, but influencing it based on clinical data before it even becomes a claim. This integration, they say, expands their total addressable market, their TAM, by over 15%. And it basically accelerates their product roadmap by almost 2 years.
So getting into clinical intelligence helps them build that perfect claim from even earlier on, creates a stickier platform.
Exactly. It potentially builds a much deeper competitive moat, making them a more holistic end-to-end solution compared to competitors focused just on the billing side. Financially, they expect it to add to margins pretty much immediately upon closing and add to revenue growth and earnings per share by 2027.
Any synergy targets? And what about debt? $1.25 billion is a lot.
Yeah, they're projecting over $15 million in cost savings, synergies, within 2 years. And on the debt, they expect net leverage to be around 3.5 times adjusted EBITDA right after the deal closes. But they emphasize their strong cash flow allows them to pay that down quickly. Seems like a well-structured plan.
Okay, that makes sense strategically. Shifting gears slightly, how are they handling the broader healthcare environment? Things like policy changes, rising costs. We heard about potential Medicaid funding shifts.
Right. They're definitely positioning themselves as part of the solution to rising admin costs, which are, enormous in the U.S., like $440 billion a year. Hospitals are still feeling margin pressure, so there's high demand for tools like Waystar's that improve efficiency. Regarding potential Medicaid changes, like the One Big Beautiful Bill Act, they feel pretty well insulated.
Insulated?
Well, they estimate even a hypothetical 15% cut to Medicaid funding would impact their total revenue by less than 1%. That's because their client base is diverse, and their tools work across all types of payers: commercial, Medicare, Medicaid. Things like finding correct insurance or screening for charity care become even more valuable if government funding shifts.
Okay, so diversification helps there. What about that prior authorization pledge we heard about, with insurers committing to streamline things? Isn't Waystar big in prior automation?
They are. They're a leader there, with solutions getting over 90% touchless authorizations already. They actually see the pledge as a positive. It pushes the industry towards the kind of standardized electronic workflows they already enable. They don't necessarily see it reducing the need for prior auths overall, but rather making the process more efficient, which plays right into their strengths. They want to lead that transition by 2027.
Makes sense. Positioned as the enabler for that industry shift. So how does all this stack up against their competition, especially given some of the disruptions we've seen, like cyber events hitting competitors?
Yeah, it's definitely a factor. They mentioned seeing continued unrest, as they put it, among clients of a competitor that had that big cyber issue last year. That's creating opportunities for Waystar to win new business. They highlighted their strong win rates. And they really emphasized their modern cloud-based platform and their independence from insurance payers.
That independence point is interesting. Why does that matter so much to providers?
Well, providers often see the payer relationship as, adversarial. They want a technology partner who's neutral, like a fair referee, just focused on getting the claim processed accurately and efficiently based on the rules. Being independent, not owned by or tied to an insurer, gives Waystar credibility in that role. It really resonates.
Got it. Okay, so strong quarter, strategic acquisition, navigating the environment well. What does this mean for their outlook for the rest of 2025? Did they raise their guidance?
They did, yes. They raised the full-year guidance for 2025. That's excluding any impact from the Iodine deal, since it hasn't closed yet. They now expect revenue between $1.03 billion and $1.042 billion. And adjusted EBITDA between $418 million and $426 million. Non-GAAP EPS projection is now 1.36 to $1.40.
So confidence for management reflecting that strong first half.
Definitely. Although they did add a note of caution about seasonality. They expect Q3 and Q4 revenue to be sequentially a bit lower than Q2.
Oh, why is that?
It's mainly due to how patient payments work with deductibles. Patients tend to meet their deductibles earlier in the year. So Waystar sees higher volumes through their patient payment solutions in the first half.
Yeah.
It normalizes a bit in the second half as more costs are covered directly by insurance. Pretty standard seasonal pattern.
Okay, that makes sense. So how did the market take all this news? The beat, the raise, the Iodine deal?
The reaction was constructive, positive, but maybe not explosive. Shares went up about 1.15% in after-hours trading right after the call, and then closed up about 3.6% the next day on pretty high volume.
So a decent pop, but maybe suggests some of the good news was already anticipated.
Yeah, that's likely part of it. But the overall feeling from analysts seems quite bullish. The clean beat, the raised guidance, and the Iodine acquisition, which is seen as strategically very smart, are all being well received. Consistent execution is definitely being rewarded.
Okay, so summing it up, it really looks like Waystar is firing on most cylinders. Strong execution, AI driving real results, and a big strategic move with Iodine to expand their reach.
Absolutely. That Iodine deal really signals their ambition to move beyond just RCM towards being this broader AI-driven platform from the clinical side all the way to cash collection. For investors, obviously, the key things to watch will be closing that Iodine deal smoothly and integrating it effectively. Plus, continuing that strong execution and cross-selling. But their high NRR and their track record of paying down debt show good operating discipline. And the need for efficiency in healthcare isn't going away. The stock, by the way, is currently trading around $37.04.
All right, let's put on our hypothetical investment committee hats. Welcome, folks. So the Q2 numbers were clean, guidance up, Iodine deal looks smart, extending into clinical intelligence with AI. Seems like a strong story. The market liked it, but maybe didn't fully price in the longer-term potential here, especially that perfect, undeniable claim vision. That could be a multi-year value driver if they pull it off.
Agreed. The underlying business looks solid, and the Iodine deal adds a significant growth lever. So given that and the sort of moderate stock reaction, here's a two-part thought experiment. Again, purely hypothetical, not advice.
Okay, let's hear it.
Idea one, a longer-term bullish play using LEABs. LEABs are long-term options. With the stock at $37.04, you could maybe consider buying a way call option that expires way out, like January 2027, maybe with a strike price a bit above the current price, say $45.
Okay, so a Jan 2027 $45 call. Why that far out in that strike?
Well, it gives plenty of time over 2 years for the Iodine synergies to really kick in, for the AI strategy to show even more results, and for the stock to potentially move higher. If you believe the guidance, the NRR, the deleveraging story points towards, say, $50 plus in the next 18-24 months, this EAV gives you leveraged upside participation with your risk defined to the premium paid.
Okay, so a leveraged long-term bet on execution and synergy realization. What's the second idea?
The second idea is more tactical, shorter term, playing the potential volatility or lack thereof around the Iodine deal closing. Management guided for a year-end 2025 close. M&A can sometimes slip, sometimes accelerate. That creates uncertainty. So one could consider something like a short-dated iron condor option strategy on Way, maybe expiring around December 2025.
An iron condor. Explain that briefly.
Basically, you're selling an out-of-the-money call spread above the current price and selling an out-of-the-money put spread below it. You collect premium up front. The bet is that the stock will stay within a defined range between your short strikes until the option expires, likely around the time the Iodine deal closes. If it does trade sideways or drifts slightly, you keep the premium. It's a way to potentially generate some return while waiting for the deal catalyst, but it has defined risk if the stock moves sharply outside your range.
So the LEP is banking on long-term growth. The iron condor is more about capturing premium during a period of potential consolidation before the deal closes.
Exactly. Two different ways to express a generally bullish view, depending on your time frame and risk tolerance, both rooted in Waystar's strategy and performance.
Interesting ideas. Okay, so to quickly recap our deep dive, Waystar put up a strong Q2. Good revenue growth, solid margins, raised the outlook for the year. And this is all really driven by their AI innovation delivering tangible results for providers.
Right. And that Iodine software acquisition is a potentially transformative step. It pushes them into clinical intelligence, expands their market significantly, and promises long-term benefits. Their ability to keep winning clients, keep those clients spending more at high NRR and handle industry pressures really positions them as a key partner for healthcare providers needing efficiency. It's a compelling narrative.
We've covered the strategy, the numbers, even tossed around some provocative ways to think about the stock. Now, looking ahead, what really stands out to you about Waystar's path? Particularly this quest for the perfect, undeniable claim. How significant could that be if they achieve it?
Well, before I answer that, just the standard but crucial reminder. This discussion, including those trade ideas, is purely for informational purposes. It is absolutely not financial advice. Please, everyone, do your own research and due diligence.
Absolutely. Essential reminder. Okay, thank you for joining us on this deep dive into Waystar's Q2. We'd love to hear your thoughts on their performance and future prospects. Until next time, stay curious and keep learning.